Hello and welcome to this week's fund review. I'm Brian Williams from Northshire Consulting, and we run the 401k and Beyond Facebook group. We appreciate everybody who's part of that group and who votes on a regular basis on which funds get selected. So what we do each Tuesday is we select a mutual fund category. We list the 10 biggest funds in that category and let you, the group members, decide on which fund we take a deeper look at. So this week we're looking at the Vanguard High Yield Corporate Fund, ticker symbol VWEHX. We should also point out this fund does have another share class available. That's ticker symbol VWEAX. That has an expense ratio of 13 basis points. We'll talk about that more later, but this ticker we show here, VWEHX, has the expense ratio of 0.23. And the reason we're showing this particular share class is it does have a lower minimum initial purchase requirement. So this share class has 3,000, where to get into the more cost-efficient share class, it is a minimum of 50,000. So keep that in mind as we review the performance and the expenses for this fund. So when we talk about high yield overall, your initial reaction is high yield. That's such a great sounding name. Who wouldn't want high yield, right? And the other word for that is at the other end of the spectrum, junk bonds, which you may or may not have heard before. So this is a tricky segment to cover, a tricky category, because it is a segment that is a little bit more risky than the overall bond market, which we normally think of as being fairly conservative. And then within that group, there's a whole cross section of more conservative high yield funds and then more aggressive high yield funds. So that's where we're at with this Vanguard High Yield Corporate Fund. It's in a category that's fairly aggressive, but it's one of the more conservative options in that category. This is a very large fund. One of the things they do to sort of help with the size of the fund and make it a little bit more make more liquidity available is they do have some treasuries in here, which we'll talk about a little bit more. But this follows the benchmark, the Bloomberg Barclays US Corporate High Yield Total Return. So this is, again, focusing on that high yield market. So this is, to take a further step back, what are bonds, right? You're loaning money to potentially a government or a business entity. Those are what bonds are. So you're loaning money to companies that the market sees might have a difficult time paying that money back to you. So this is taking a little bit of a risk with your bond portfolio. So if you liken that to, go back to high school, loan your friends some soda money, we'll say, and then you knew which group of friends were more likely to pay you back than others. So this is that group that might not be as likely to pay you back as some of your more some of your friends were a little more trustworthy. So not to say that they won't pay you back or that money's gone, but you might have to chase it a little bit. So that's what this category is, if you think about it that way. A reminder that this video is to provide general education. Nothing shared in this video should be considered any specific tax, legal, or investment advice, and certainly don't act on any information you see in this video without first consulting your tax, legal, or investment advisor. We are an independent investment advisory firm with no affiliation to the reviewed fund. We may or may not have a position in this fund with client assets. So the ticker symbol, like we talked about before, for this share class is VWEHX. The fund has been around since 1978, and it's pushing 30 billion inside of the fund. So this is a fund category that, like small cap growth or small cap value, there are some capacity issues here. So this is a fund that has been closed before. And actually, when it was closed before, it has more assets now than it had back then. So there's always a potential that this fund could close again. There's a couple different kind of fund closures. One is considered a soft close, meaning if you have money that's in this fund, you're allowed to add to it, but they won't take on any new investors. The other would be what's considered a hard close, where they just cut off all new money flowing into the fund. And that's because funds get to be a certain size, but they play in a space where there's just not a lot available. So they may be a size in a high yield corporate bond fund where they'd essentially have to buy the whole offering to make it worthwhile or to have any sort of impact on the portfolio. So that's what we're seeing here. This is an actively managed fund, meaning you have a management team led by Michael Hong, who's been there for 13 years, who are picking the bonds that are going to be in this portfolio. They're not picking from a list or trying to mirror the high yield market exactly. So this is an actively managed fund. The difference between active and passive is a little bit different here on the fixed income side than it is on the equity side. The equity side, it's a little bit easier, right? If you're following the S&P 500 and you want to buy a mutual fund that follows that, that mutual fund is basically going to hold those 500 or so stocks at the allocations that the index says. Whereas a bond index is going to cover the whole market. So it's almost impossible to replicate that market exactly. So when you're looking at you're looking at an index, it's really going to be difficult to find a fund that exactly mirrors that index. So an actively managed fund here, obviously they're watching their index and they're benchmarked against it, but they're not specifically an index fund. So like we said, Michael Hong's been there for 13 years. He does have a team behind them. This is like a lot of other Vanguard actively managed funds. This is subbed out to Wellington, which is a group that runs this portfolio for Vanguard. From an asset allocation standpoint, this is about what you'd expect. So you've got 76% in US bond and another 15 in non-US bond. So that's making up about 91, 92% of the portfolio here. Some in cash, which is really just short-term treasuries. The reason they're holding that is to handle liquidity. So when there's periods where there's a lot of redemptions, people trying to take money out of the fund, they don't necessarily have to sell securities that they want to hold long-term to fund those redemptions. So that's where there's a cash position there. Also money flowing into that. If the market isn't right for high yield and they get a ton of money that flows into this, they don't necessarily have to invest that right away. They could hold that in the short-term cash. So that's why I see a cash position there of 5%. When we look at equity funds, we always look at the top 10 holdings. And here, this doesn't tell you a whole lot at first glance because it's not showing the companies that they invest in other than T-Mobile and some others. But what it does show you is the U.S. Treasury note position here. So there is about 7% of the portfolio that's invested in these U.S. Treasuries to give that stability, to provide the liquidity, and also move the overall fund up the credit quality scale. Here is that credit quality scale. So you don't see it differentiate from the category too much until you get into that BB rating. So Aaa corporate bonds, they're going to be your best of the best. These are companies that the market says, the rating agencies say, are absolutely going to pay you back with the interest at the set periods. Once you move down that scale, it's less likely the rating agencies are saying that these companies will be able to pay you back. So at that BB rating, the fund is overweighted compared to the category, 54 to 38. And then that next level, which gets a little more risky, you're seeing 29%, 28% invested in single B, whereas the category is about 37%. So just that little bit of differentiation there, BB to B, is what makes this fund a little bit more conservative. And of course, you've got the AAA a little bit up there at the top. That's the treasury portion that goes in there. And even below B rated, you're seeing only 6% invested there, whereas the category has about 15% there. So just another way to illustrate how this fund is more conservative than its peers. We talked a little bit about the expense ratio before. You do have the two different share classes at 13 basis points if you meet that $50,000 minimum, or 23 basis points with a $3,000 minimum. That's 0.23% or $2.30 fee for every $1,000 invested. Whereas the category on average charges about 82 basis points or $8.20 for every $1,000 invested. So that's internal, of course, the cost of the fund, and that comes right out of your return. So if you look at it on this scale, basically the category has to outperform this fund by 60 basis points every year just to break even, because on average, they're more expensive. So that's typical of Vanguard funds, not just on the index side, but the actively managed funds. That you always hear from Vanguard, active at the right price. Even though they're considered that index shop, they still do believe in active management. It just can't cost too much because that cuts into the returns. Here's an example of the Vanguard corporate fund against the categories. So they've outperformed 4 out of the last 10 years. I know that doesn't sound great, but when you look a little bit closer, 2018, 2017, you see they're right there with the category. So, a couple days here or there, and they could have easily outperformed 6 out of the last 10 years. So what you look at, what you want to look at too is how they performed against the years when category was down. So if you look at 2015, the category was down almost 4. This fund was only down 1.4%. And then another year when the category was down, 2018, they were basically right there with the category. So this fund, so that's an example of how this fund is a little bit more conservative than the category. But then you look in big up years like 2019 or 2012, and it's right there. So that's really what you're looking for, not just out of the high yield category, but really any fund. You want them to not be down as much as their peers, and then up as much as their peers on the upside. So that's called upside downside capture ratio there. And this fund is pretty good in that department. A reminder to always go straight to the source. We don't know when you're going to be watching this video. It's recorded here early June 2021, but you can always go right to Vanguard.com. They have some great information there on their funds. And of course, Morningstar.com, where you can get that information about its peer groups and how it compares to the index, all right there at Morningstar.com. Before we get into some additional performances and how we use this fund was selected by the group through the 401k Beyond Facebook group. So if you're watching this on YouTube, we urge you to check out that group. Here we are looking at it against the index. So before it was a category, here's the index, outperformed 5 out of the last 10 years. So similar to the category, when you look at years like 2013, when the index was up quite a bit, this fund was up significantly too. The years in which the index was down, 2015, 2011, 2018, the fund was pretty close to the index. In 2018, the other 2 years, it significantly outperformed the index. So again, that's what you're looking for. You're looking for it to keep pace on the upside and not have as much downside. A reminder about the disclosures here, not any specific tax, legal, or investment advice, really just general education. So overall, we'd rate this fund a B+. What's tricky about this fund is if you're not sure where to use it or not sure how it fits in your portfolio, just don't use it at all. You will find in the aggregate index and a bond index fund, there is a little bit of high yield in there. You'll also see in some of your actively managed sort of go anywhere, all asset funds, there's usually a sleeve of high yield corporate in there as well. So you want to make sure that you're not overweighting to corporate high yields here, because if you're adding this fund and you already have a position in high yield inside one of your other funds, you might be a little bit overweight there. This is a category who's had a pretty good run over the last 10 years or so. You'll see this category tied a lot to the equity markets. So when the equity markets are doing well, this is a category that does well. Certainly don't chase yield here, especially we're in a yield environment where, bank savings accounts and CDs and short-term bond funds aren't paying that much. And with the inflation fears kind of kicked in, I know it can be tempting to look at this fund and say, well, it's a bond fund, it's pretty conservative, and it's averaged pretty well over the last few years. But really make sure you understand why you're putting this in your portfolio. And if you don't understand why you're putting it in there, don't put it in there at all. So again, Brian Williams from Northshire Consulting. We appreciate everybody in the group who voted for this fund, and be sure to check us out each Monday for Mutual Fund Monday. Thanks.